fertilizers, a word that can make many people concerned about the danger of it on our environment, but at the same time, a product that is essential for our farmers looking to increase their crop yield. But today, you'll discover the world's largest producer of potash and the third largest one of nitrogen, which are two key ingredients in the production of fertilizers. So you'll find a full stock analysis going from the business model to the price prediction of the company Nutrien with the ticker NTR. Without further ado, let's get to it right now. Nutrien is a Canadian fertilizer company based in Saskatoon in Saskatchewan. As I just told you, it is the largest producer of potash and the third largest one of nitrogen fertilizers in the whole world, with about 2,000 retail locations in North America, South America, and Australia, and with over 20,000 employees all around the globe. This company that currently worth over $30 billion operates a network of production, distribution, and retail services to meet the needs of their worldwide customers. So their products are mainly used to support the plant growth, help to increase the crop yield, and to enhance the water preservation in order to help our farmers to feed the global population. Since 2018, they've been able to increase the sales of their manufactured fertilizers products by their retail channels by over 20%, and they've been able to increase their proprietary product gross margin by about 38%. However, you need to know that the potash and the nitrogen fertilizers markets are both considered as some cyclical market, meaning that the price of the products will depend on which cycles are they currently in. Usually what happens is that when the price of it will rise and reach the top, it means also that many people won't be able to buy as much of this product as in the past. But on the other side, when the price of the product will drop, it means that more people will be tend to buy more of it. And when we take a look at the fertilizer market represented in that case by the potash spot price, we can see that since 1 year it has been on a massive downfall. And this downfall of the fertilizer market over the last year has been massively impacting the earnings of this company, where we can see that over the last 4 quarters they have all missed the prediction of the analyst, and where we can see that in their latest earnings report we can see some important decrease in the total sales and in the total earnings of this company. But in fact, what has caused this massive switch of cycle in 2022? First, you need to know that the potash market in the world is divided between 3 countries, which are Canada, Russia, and Belarus. And on their side, both Belarus and Russia are worth about 20% each of this total market. So you can understand that with the ongoing war in Ukraine, the worldwide community has put many sanctions to Russia and Belarus concerning the potash production. And so this has had a certain impact on the total supply and exportation of this product worldwide. However, it is also important to note that recently there have been some high levels of investment by the important producers, notably by the creation and the coming of new entrants on the market, notably with the coming of new companies such as Eurochem that has had the impact to boost the production of potash worldwide. Nevertheless, the most important factor and the most frightening one for the investors concerning these type of companies is obviously coming from the climate change point of view. Indeed, the need to reduce our carbon emission will be a massive theme for the next 20 years, and it makes that the global potash markets are currently at their more uncertain point since the last 50 years. All of these factors combined together can make many investors quite afraid of this type of company, but keep in mind that as a cyclical company, it means that as low as the price of the good will go, as much as the farmers in that case will be able to buy of these fertilizers to apply in their production. And the good news about that is that since June we've assisted to a certain stabilization of the global fertilizer prices, which can imply that the farmer can be able to apply more volumes of it for the end of the year and for 2024. And while the Muriash of potash, or the MOP, is still the most widely traded potassium fertilizer, exceeding 65 million tons of exportation annually, while most of the important countries in the world such as China, India, Brazil, and the US still need to import massively of these kind of products. And so it means that on their side, they will still continue to have a certain need on that side for all all their farmers as long as they are not able to find a better solution. And where it is estimated that the exportation of Belarus is down of about 4 million and the exportation of Russia is down of about 2 million compared to 2021's level, this could be a great opportunity for the Canadian market to capitalize on these lost parts of those markets. Especially when we know that the leading company in the world is currently down of over 20% since the beginning of the year. But before to determine whether or not you should buy this company and to judge what is its long-term potential, let's make a quick fundamental analysis followed by a price prediction to determine its true value. First, as I told you earlier, we can see that this company currently worth about $30 billion, but most importantly, with some pretty attractive price to earnings, price to sales, and price to book ratios, showing that according to these metrics, this company would currently be undervalued. But in terms of the profitability of the company represented by the profit, the operating margin, and the return on equity over the last 12 months, we can see that they haven't been that impressive. And during that period, we can see that by generating some revenue of close to $30 billion, they have, however, seen some quite important decrease in their latest quarterly revenue growth of about 32% and some impressive decrease of over 95% in their latest quarterly earnings growth. And an important criteria about this company is that they don't have that much cash compared to their total debt, despite having a quite fair debt to equity ratio of about 60%. Now, when it comes to the volatility of this company represented by the beta on a 5 years period, we can see that over the last 5 years, this company has been pretty much following the market fluctuation. But over the last 52 weeks, we can still see that it has lost about 32% of its value compared to the market that has been up of about 10.78%. But an interesting fact about this business for all the dividend income investors is that by investing in it, you can expect to receive about 4% of quarterly dividends with a pretty good payout ratio of only about 47%, showing that the dividend is still quite sustainable on the long term. And despite some quite important decrease over the last 12 months of their total revenue compared to 2022, we can still see some important increase over the last 4 years concerning them. And this has been pretty well reflected in their total earnings over the last 4 years. And the scheme is pretty much the same in terms of their operating cash flow that have been growing quite well over the last 4 years, despite some important decrease over the last 12 months, which has resulted in some great positive free cash flow progression during that period. As always, to determine the true value of this business, I'll start by using the Peeler-Lynch valuation model, which is a simple formula where you come add the future growth of the earnings per share with the dividend yield and that you divide by the price to earnings ratio. And with the results of this formula, we can find that this company would currently be quite overvalued right now. With the second model, which is the dividend discounted model, we'll simply come use the past dividend payments over the last 5 years that we will come discount. And with this model, we find that the intrinsic value of this business is about $12 compared to its current price of about $53, showing that it is also overvalued according to it. Now, the third model is the discounted cash flow model, where we will simply discount all our future cash flow, starting by finding what is our discounted rate or the weighted average cost of capital that we'll find by finding the cost of debt, the cost of equity, and the cost of debt and equity. And by discounting all the future free cash flow of the company, we can find that this company would currently be worth about $96 per share, which would currently be quite undervalued. And finally, the last two models are the Graham's original value formula and the Graham's revised value formula, which in both cases are giving us an intrinsic value of only about $30 per share, which is showing that this company would also be quite overvalued right now. So, as you've been able to see in this video, Nutrien has a quite volatile business model that will obviously fluctuate a lot depending on which cycles in which they are. Right now, the stock is down of more than 20% and we are still far from the top of the cycle. But despite a quite positive valuation of the discounted cash flow model, we have seen that all the other financial models have shown that this company would currently be overvalued according to them. And while winter is coming, which will obviously impact the farmers in Europe and in North America. I would personally wait a little bit before to invest in that company to see some great positive news from it and also to see a quite important switch of cycle. And it is why I'm waiting for some great positive earnings and some great increase in their total sales and in their total earnings before to invest in it. But on your side, if you're looking for other great ways to grow your total capital on the stock market in 2023 and in 2024, well, check out the video that's gonna be right over here, and I will see you soon. Peace.